important. Normally, the midterm is about 3-4 hours. It also depends on participation. So if it really depends each time. I'm not going to spend too much time on theory because I don't like, I find like it's better to learn it while doing the problems and like learning the theory by heart. So I'm going to just skip to like the important points. Can you guys just confirm that you're seeing that I'm recording and you're seeing like the chapter 13 PowerPoint? Yeah, okay, thank you. So chapter 13 is about current liabilities. So it's anything that's going to be that the company owes to someone. It can be cash, it can be products, it can be anything like that within 12 months. So if the year ends December 31st, it's anything that they owe within a year. So from January 1st of the next year until December 31st of the next year. So that can be wages, that can be debt, that can be provision, that can be warranty accruals, that can be all those things. So I'm going to skip through that. There can be two types of obligations / liabilities. There's what we call legal obligation and constructive obligation. For legal obligation, it comes from a contract. So if you have a contract with the supplier that you have to, like an invoice where you have to pay something within 30 days, then that's going to be a liability that you're going to have to put in your statements. It can come from law, so like the Income Tax Act. So you have to pay your taxes every year. So if you are required to pay taxes for 1 year, then you're going to have to accrue it in your liabilities if you haven't paid them yet. It can also come from other things of law, like if you receive a fine or a penalties from the government because you hadn't paid your taxes, for example, that you need to accrue as a liability. A constructive obligation comes from like the entity's action. So if the entities, well, the company says, okay, I'm going to pay all my employees a 6% amount of vacation, then by law, they only need to pay 4%, for example, but they decide to pay 6%. Then since they decide to pay 6%, and that's what they've always done, when they're going to calculate the amount of vacation that they need to pay, they're going to use the 6%. So when they book their liabilities for the vacations that they need to pay, they need to use a 6% amount. That's the type of constructive obligation that you can do. It can also be like the company says to another company, I'm going to give you a 1 million donation, but there's no like, it's not written paper, it's informal. But since they already said to that company, okay, I'm going to give you a $1 million donation, they have to book it in their financial statement as a liability. There's financial liabilities and non-financial liabilities. Financial liabilities comes from contractual obligation. So where there's a contract, and it doesn't have to be only cash. It doesn't have to only be I owe you money. It can also be I owe you a product or a service. And then non-financial liability. Oh, sorry. Financial liabilities are only paid with cash and they come from contractual obligation. Non-financial are when it's paid with services and goods. In non-financial liabilities, you also have provision. Sorry, my cat's going to be in the way a lot. Okay. So provisions are when you know you're going to owe someone or a company something, but you don't know when you're going to have to provide like the cash, the service, the good, and you don't know how much you're going to owe them. So best example for provisions is when there's a lawsuit. So when you're getting sued and you think you're going to lose, and so you know you're going to lose, but you don't know how much you're going to have to pay because the lawsuit, whatever, hasn't been settled yet, and you don't know when you're going to have to pay it because same thing, the lawsuit hasn't been settled yet, but you know you're going to owe something. So you're going to have to book a provision in your liabilities for the best estimate of what you think the outcome of the lawsuit will be. So if your lawyer thinks, okay, you're going to have to pay $1 million, in 2 years, then you're going to book $1 million in your liabilities. Current liabilities, anything that's settled within 12 months. You don't need to know all of this thing. Just know it's settled within 12 months. And these are examples of current liabilities that can be asked, but the most common that are asked are for anything that's linked to payroll, so payroll deductions, and also employee benefits like vacations or sick days. And I found that there's no like good way to like know it by heart. It really depends on the problem that's presented, and depends on how the company decides to accrue their payroll deductions and their employee benefits. So you just really have to be careful when reading the problems regarding this topic. So you make sure that you're not missing a percentage, or you're not missing like a really important sentence that like switches how the vacation is going to be booked. Your book, I know there's a new edition, but before in your book, there was really good problems regarding vacations and sick days. I don't know if it's still there. I think it was like exercise 12 and 13. If it's still there, I recommend practice it. And if you understand it, you're going to be good with that. Another short-term liability that you're going to be asked for, it can be in multiple choices, is going to be about callable debt. That is when you get a debt with the bank, and in the terms it says that it can be due at any time. So the company can say, okay, well, no, not the company, the bank in their terms are going to say, okay, well, the maturity of the debt, so when the debt is going to be done and going to be all repaid for, is going to be like in 2030, but we can ask you at any time until 2030 to pay it back. So since you don't really know when you're going to have to pay the full amount, you just know that you have like a set in stone deadline. The debt needs to be classified as current, because at any time you could use your cash to pay it. So you could pay it back next year, you could pay it back in 2 years, you don't know. So you need to classify it as current. A debt can also become callable if you have covenants in your debt agreement with the bank. So covenants are like certain ratios that need to be respected, or a certain amount of employees you need to hire, stuff like that. And if that covenant is broken, so if, let's say, you had a specific ratio and you didn't meet it for 1 year, the debt can become callable. When that happens, you're going to classify your debt that was maybe before long-term, short-term, because the bank is going to ask you to repay it because you broke the covenant. So now you have to pay it back. Under IFRS, a callable debt is always going to be current, even if the bank is like, okay, the recording should be posted today. Normally I post it within the day. So under IFRS, it's always current, because even if the bank is like, okay, I know you broke the ratio, or okay, I know your debt is just callable in general, I'm not going to ask you to pay it back within a year. I'm going to ask you maybe to pay it back in 2 years or 3 years. But for IFRS, if at the date of the statements, of the financial statements, so if their year ends December 31st, at December 31st, if they don't know that they're going to have that agreement to defer the payment in like 2 years, then they have to put it as current. For ASPE, it could be put as long-term if the bank gives to the company in written form a waiver saying we're not going to ask you to pay it back within a year. And also if there's like covenant requirements that they broke, if they don't think that they're going to break the requirements within a year again. So if they think, okay, I broke the ratio, but I'm not going to do it again in a year, and my bank gave me a waiver in writing saying that they're not going to ask me for repayments within a year, then you can put the debt as long-term.
Florence, just a question.
Yes.
Regarding IFRS.
Yes.
If, let's say, they go to the bank prior to the year end and they get that like waiver, then it could still be considered non-current, correct? Because they're doing
Exactly.
it before the end of the year.
Yeah, exactly. Exactly.
Okay, thanks.
No problem. Then the next topic that can be asked is short-term debt expected to be refinanced. So that's when your debt is coming due within a year and you have to pay it back within a year. But then your bank, or you go and get a new debt that is going to be for, I don't know, 5 years. And then you use that 5-year debt to pay for your debt that is coming to term in a year. So since the short-term debt that was due within a year is going to you're not going to actually pay any cash for it. You're not going to settle it with cash. You're going to settle it with a new term. Do I classify it as current or long-term? Because now it's going to be long-term since I get a new long-term debt. So you're not going to pay any current assets for it. So why would you classify it as current? Under IFRS, the short-term debt, so the debt that is due within 1 year, is going to be classified as current regardless of if there's a refinancing that is done. Even if there was a refinancing that was completed before the financial statement are released. It can be a long-term classification if the entity at the date of at December 31st, for example, expect to refinance it or roll it over under an existing agreement for at least 12 months. So that's the same thing as callable debt. If on December 13, they entered into a refinancing agreement for 5 years, then they could classify that debt as long-term because they know before the end of the year that debt is not going to be due within 12 months. If the refinancing is done in January, then they're going to have to classify that debt as current. And also, it's at management discretion. They can also decide to, even if they know that there was a refinancing that was done in December, they can decide, okay, I'm still going to put it as current. Under ASPE, the difference is if the refinancing was done prior to the release of the financial statement, they can classify the debt as non-current. But the thing is, the debt has to be refinanced on a long-term basis. So the new debt has to be due in more than a year. And the refinancing is done before the financial statements are completed, and nothing stands in the way of the refinancing to occurs. If the long-term debt amount, like the refinancing amount, is lower than the short-term debt that they had in their books at December 31st, the amount that they can put in their long-term debt can only be as high as the refinancing amount. So if they had a short-term debt of $1 million and they get a refinancing of $500,000, they can only put in their long-term liabilities $500,000. The balance is going to be current because the balance hasn't been refinanced. They're going to have to pay cash for it within the year. Any questions? The best way to go about it for this is to do just a timeline. Put your year end, put when the refinancing was done, and put when the financial statements are released. And then from there, like assess, okay, can it be classified as long-term? Asset retirement obligation. That's when the company, for example, has a project where they're going to go and mine. Like they go take a land and they're going to mine that land. And at the end of the project, they have to restore the land as if like nothing happened, as if they were never there. So maybe they have to replant trees, or maybe they have to plant some seeds for grass, stuff like that. That amount has a cost at the end to put it back into good conditions. So that amount needs to be estimated at the start of the project and booked as a liability in the books of the company at the start of the project. So at the start of the project, they have to estimate how much it's going to cost them to put back that asset into proper care. So mining happens a lot. It happens a lot. What I have, but nuclear facilities. So if there's a nuclear plant, they have to, like, I guess, clear the nuclear waves from the air, landfills, stuff like that. So under IFRS, the obligation, so the arrow is going to be both legal. So if the government or if a supplier, or if you have a contract to put the land back into proper care, that's going to be recognized under both IFRS and ASPE. But under IFRS, you're also going to have to think about constructive obligations. So if the company was like, okay, I promise that at the end of the project, I'm going to do X, Y, and Z to put it back in proper care, and that's the cost that's associated with it, then you're going to have to also estimate it at the beginning of the project and book it at the beginning of the project. The transaction that you're going to do with Arrow, you're first going to capitalize the asset. So you're going to, for example, capitalize the land for mining. And so that's like when you acquire an asset like in ACCO320. And you're also going to recognize the asset retirement obligation. The asset retirement obligation, this is your liability here. So this is your future costs associated with your project. And that's going to go against your asset. So it's going to come and increase the amount of your asset. So your asset is going to be depreciated over the time of the project. And the cost is going to be the cost of the asset plus the asset retirement obligation. You might also have cost that comes from overhead from the ongoing activity. So if you're mining, maybe there's you have a cost associated with how much you mine. So that depends on how much is produced, and that cost is going to be added, well, to your obligation at the end of each reporting period. Under IFRS, that cost is put in manufacturing overhead, and under ASPE, it's going to come and increase your asset. So under ASPE, everything goes to asset, but under IFRS, you have a portion that also goes into your manufacturing overhead. Normally, they're going to tell you, like, if you have that at your exam, they're going to tell you, okay, there was 20,000 that was of cost that was incurred due to the production of the year. So then you're going to have to book this journal entry in your exam at the end of the period. Your arrow needs to be present valued because maybe you're estimating that it's going to cost you 25 million at the end of the project. So how much is that 25 million worth today, 25 years before? So because of that, you're going to have to book an interest expense under IFRS or an accretion expense under ASPE. They're the same thing, just different names, where you're going to record like the present value effects of bringing your asset retirement obligation to 25 million at the end of the project. So every year you're going to calculate, okay, my interest rate times my arrow, that gives me my interest expense. I'm going to add it to my arrow so I get a little bit closer to my 25 million that is due at the end of the year. Because the projects are normally long-term, they're really on a long period of time, there could be changes in the cost that you expected at the beginning of the projects. So let's say the project is on 25 years. And in 10 years, you're like, okay, I thought it was going to cost me 1 million, but now I see it might cost me 5 millions. Or maybe they think that there's going to take longer to complete the project or shorter. Then you're going to have to reflect those changes and estimate into your arrow. So you're going to calculate the new present value of your estimates. And you're going to compare it to what's currently in your books. And you're going to adjust for the difference. And the difference is going to be booked in gain or loss and going to affect your P&L for the year. And at the end of the project, you're going to actually pay cash or issue shares or whatever that was promised for the project. So you now have the actual amount that you had to pay. So you're going to, for example, credit your cash, that's the actual cost. And then you're going to reduce also your obligation that you had expected for the 25 years. And the difference between the two is also going to be booked as a gain or loss on the commission. Any questions on Arrow? We're going to do a problem anyway, but okay. For product warranties, that's when you go, if you go and you go buy a phone, you might have a warranty that comes with it, which covers costs for your phone if there's anything that happens. There's two ways to account for product warranties. There's the expense base and the revenue base. For the expense base, it's when you buy your phone and it's already a part of the purchase price. So I buy my phone and it comes with a 1-year warranty, and whether I want that warranty or not, it comes with it. I cannot buy it separately. So what happens is you're going to book your sales revenue as normal. So the price of the phone times the number of phones that was sold. And then for your warranty, you're going to book at the same time as the sale a warranty expense that is the estimation of how much you think the company will have to pay to provide that warranty service. So if they think, okay, I think that 35% of the people that bought the phone are going to have to use a warranty, and I think it costs me $10 to provide that service, then you're going to calculate that amount based on those estimation. The warranty expense, the other leg of the transaction, is a liability. So liability of what you think you're going to owe for that warranty. And the liability is going to come and get reduced by the actual cost that the company incur for the warranties. So if you set up a liability at the beginning of $2 million because you thought it was going to cost you $2 million, then at the end of the year you see, oh, okay, it actually cost me $200. Yeah, that's a big, like, it actually cost me $1.5 million to provide the warranty services. Then you're going to come and reduce your liability amount by 1.5 million. So now you're left with a $500,000 of liability that might be used in the next year, depending on the terms of the warranties. The revenue base is when you go and buy your phone. You buy your phone and you have the option to buy a warranty or not. So I go buy my phone, I decide to buy a 5-year warranty. So what I bought, you had two services and goods. You had the phone that you sold, and you also sold the warranty. So you have to account for those sales revenues separately. So at the time of the sale, you're going to have your sales revenue, which is going to be the amount of the phone because you actually delivered the phone right then and there. And you're going to also have an unearned revenue portion that is for the warranty services. Since the warranty services haven't been provided yet, because unless like they drop the phone like the second that they paid, like you haven't given them like their service associated with what they bought. So the revenue for the warranty is going to be recognized over time, and it's going to be recognized when the warranty services are actually provided. So your liability in this case is your unearned revenue, and your warranty expense is going to be the actual cost of warranty that are incurred by the company when they provide the service. Premiums and rebates are accounted for under the expense approach most of the time. I think that on your assignment, there was also the revenue approach, but it's similar accounting as warranties. So you set up of how much you think you're gonna have to pay for the premiums, and then you're gonna reduce your premium liability by the actual amount of premiums you had to pay out. Contingencies. So that's when you know that there's an existing situation that happened in your company that's going to involve a possible gain or loss to the company, and it will be resolved when an event in the future happens or fail to happen. So these are very like vague terms, but if I take my lawsuit example as of before, if at December 31st, you received a letter in the mail saying you have been sued for this, this, and this, you know that's your existing condition or situation that exists at December 31st. You're like, oh shit, I need to book something for that because I have an existing condition, but I don't know how much I'm gonna have to pay. I don't know when I'm gonna have to pay. So I'm gonna have to see if I need to really book it. Under ASPE, you're gonna have to book a contingent liability when it is likely that the event's gonna happen. So there's a 70% probability that you're gonna have to pay out because of an amount of money because of the lawsuit. And the amount that you're gonna pay out can be reasonably estimated. So you're either given like a specific amount that you're gonna have to pay, or you're given a range of different amounts with different probabilities of the amount that you're gonna have to pay. If you're given a range, under ASPE, you're gonna put your contingent liability as the lowest of the range, and you're gonna disclose in the notes of the financial statement the remaining possibilities, possible loss that you're gonna have to pay. Under IFRS, you're going to record a provision. So it's a provision under IFRS when it's probable that you're going to have to pay for the lawsuit. So probable here means there's a more than 50% chance that you're going to have to pay cash for that lawsuit. So the bar is lower than under ASPE. Under ASPE is 70%, under IFRS is 50%. And also, same as under ASPE, you're either given an amount, like a point, like a set amount, you're gonna have to pay $500,000. And under IFRS, if you're given a range, instead of just booking the lowest, you do a weighted average of all the possible outcomes, and you're gonna book that weighted average. So if I have a 10% probability times an amount plus the 20% times an amount, etc., until you get to 100%. So that was for the theory for chapter 13. The PowerPoints are already booked in, already posted in the Facebook group. Whoops, that's the solution, that's for me. That's it. Where is my, okay, I got it. Where's on my computer? Okay, so like I said, the PowerPoints are already posted in the Facebook group. You just have to go and look under files. If you have any questions on the theory, you can ask me on Facebook, like by messaging me or just posting on the group. Your multiple choice question are not going to be like only like what is a legal obligation, and then they're going to give you a definition. It's more going to be like in situation, like is this, and then they put a description, a legal obligation, yes, no, how much are they going to need to book, stuff like that. Yeah. So the first problem is going to be on warranties. So Screens and Things manufactures and sells high quality digital products. One of the popular products is a commercial cloud-based digital storage unit called Storit, which it sells for $5,100 per unit, and which comes with a standard 1-year warranty. The company also offers its customer a separate 3-year extended warranty commencing after the end of the standard warranty at an additional charge. Under this extended warranty, S&T offers its customers a service when necessary to perform either appropriate repairs or to replace a defective unit. Based upon its prior experience years, the company estimates the total warranty cost for the standard warranty to average $150 per unit, being $90 for parts and $60 for labor. It also expects the average 3-year extended warranty cost to be $240 for parts and $480 for labor for each contract. It further assumes that the warranty cost for the extended warranty contracts will be incurred as follows: so 20% in 2022, 50% in 2023, and the balance in 2024. And finally, S&T will recognize the warranty revenues based on the proportion of costs incurred out of the total estimated costs. During 2021, the company sold 6,000 units and 5,400 extended warranty contracts. During the year, it also incurred some actual costs associated with the standard warranty related to the 2021 sales of units. The cost for the parts were 140% of the labor cost. On December 31st, 2021, S&T reported the following. So in their current liabilities, they had an estimated liability under warranty of $459,000 and unearned warranty revenue of $4.5 million. S&T incurred actual costs associated with the standard warranty related to the 2021 sales of units in 2022 amounting to $531,000, and the cost for parts therein amounted to $354,000. It further incurred actual costs associated with the extended warranty contracts which were consistent with what the company had expected to incur. So a lot of info. So in this problem, you have the 2 types of warranties. So you have the standard 1-year warranty that you cannot opt out. So that's going to be booked under the expense method. And you also have the 3-year additional warranty that you have the choice to buy or not. So that's going to be booked under the revenue approach. So for the requirements, first, we're going to have to determine the selling price for each extended warranty contract. So that's what is my selling price for each of the 3-year additional warranty that was sold. So under the revenue method, the transaction that you book when you have an additional warranty is you're going to have the cash that you receive, and then you're going to have your sales revenue, and then you're going to have your unearned revenue. What interests us right now is what is my unearned revenue amount that was booked in 2021 for the 3-year additional warranty. And they actually give it to us right here.
The 4 million.
Yeah, exactly, the 4 million. So we already have the amount. So now we need to know, okay, how many units of warranty were bought. And I think it was also given to us in the problem.
5,400.
Yeah, exactly. So during the year, people bought the digital storage unit, and 5,400 extended warranty were also purchased. So that means that my unit costs for the contracts were my 4.5 million divided by the 5,400 extended warranty contracts that were bought. So that gives me a unit cost for each warranty contracts of $840.
And so, Florence, we are able to use the unearned warranty revenue because it's at the end of the first year where the regular warranty would have expired, correct?
Even if the warranty wasn't expired, you could have used this amount. That's because at the time of the sale of the warranties, even if it was
Yeah.
at the beginning of the year, you have to book your unearned warranty
Right,
revenue.
because it's the revenue method. Okay.
Exactly. So we're gonna actually do the journal entries for 2021 for requirement 2. So my first journal entry that I'm gonna book is my sales revenue, which is exactly the same as this. And then we just need to calculate what was my sales revenue for the units, the actual product that they sold. In this case, they sold 6,000 units, and it said that the selling price of the units is $5,100. So I'm going to do 6,000 units times $5,100. That gives me 30.6 million of sales revenue. So my cash is just going to be the sum of my two amounts here. The supply, this is 6,000 units times the selling price of $5,100, and this was given. Then at the time of the sale, you also have to look for your warranty expense for your standard 1-year warranty. So what you want to book here for your warranty expense is how much do you think you're going to have to pay for providing the service for the 1-year warranty. So I have warranty expense, and I'm going to have my warranty liability. How am I going to find what my warranty expense is? You first need to find how many warranties were sold. You also need to find what is the estimated warranty cost that the company thinks they're going to have to pay for each of those warranties. So first, the number of warranties that was sold for the 1-year warranty was 6,000, because they sold 6,000 units, and each unit comes with 1 warranty. The estimated cost,
It's 150.
exactly, it's also given here. So here they say that the company estimates that the total warranty cost for the standard warranty is $150 per unit. So that gives me a total warranty expense of $900,000. So that's their estimation. That's what they think they're going to have to pay for their 1-year warranty. Then at the end of the year, at December 31st, 2021, they actually incurred some costs for that 1-year warranty. So they're going to have to come and reduce their liability that they set up at the time of the sale. So warranty liability. So they tell us in the problem that the actual costs here, actually no, they tell us, they actually tell us
150% of the labor cost.
Yeah, well, that's that's to tell you that the price for the parts and for the labors were rightly like estimated, because $90 is
yes, of course. Okay.
Yeah. What they give us here is the ending balance of the liability. So at December 31st, the ending balance of my warranty liabilities is $459,000. So that means that the difference between what you set up before at the time of the sale and the $459,000 is your actual cost for the 1-year warranty. So it is 900,000 minus 459,000. So this is my actual cost, which is the variation of the liability within the year. Since the 3-year additional warranty hasn't been like put in play yet, like it only starts when the 1-year warranty is done, you don't have to like think about the amount yet. Then you need to find, okay, what did they give out for the warranty? They gave up part and they gave up labor. So for the parts, you're going to do a weighted average with it to find the parts and the labor costs. So for the parts, you're going to do the $441,000 times $90, because that's the amount that they paid for the parts, divided by $150, which is the total cost of the warranty. And for the labor, what you're going to do is the $441,000 times $60, which is the amount that they think that they're going to have to pay for the labor, divided by $150, which is the total cost of the warranty. And that gives us the credit side of our transaction. These type of problems, they're always given out differently. So it can really vary on what's given in the problem. So be careful when reading. I think your assignment, there was a really good question about it. So if you understood your assignment, honestly, I think you're good for your midterm. So that's all the transaction that you're going to have to book regarding the warranties for 2021. So that's in the year that this sale of the units occurred. Then they ask us to prepare all the journal entries in 2022 that are related to the standard warranties of 2021. So this is for the standard warranties. So that's only my 1-year warranty that was like, that was included in the sale of each unit. So since it's been a year, technically you should have the actual costs that you had to pay for that 1-year warranty over the 1-year period. So at the end of December 31st, we had a $459,000 balance in my liabilities that wasn't used yet. So we have to go and check in the problem if they tell us if their expectation that they set up was the reality. So did they think that they thought that they were going to have to pay $900,000 for that 1-year warranty? Did they actually have to pay $900 at the end of the 1-year warranty for that warranty? I think I said too many times warranty. So that should be in the problem somewhere. They should tell us somewhere, okay, it actually cost them their expectation, or it cost them more or less.
I think it's the last paragraph, the 531.
Yeah. So what they tell us here is that in 2022, they incurred costs of $531,000 for the 1-year warranty. So we had a leftover amount of $459,000. So it should have, they expected that it to cost them $459,000, but it cost them more. So you're going to have to book a gain or loss for the difference between the two. So if we first set it up, you're going to want to come and reduce your warranty liability for the total amount that was left in the account at year end. So $459,000. So this warranty liability is gone. It doesn't exist anymore. It's at 0 on your statements now. Then you want to book your $531,000 $1,000, which is going to be split between your parts and your labor. It says that the cost for parts is $354,000, so that's what I'm going to put. And the difference is going to be, well, the labor is going to be the $531,000 minus the $354,000. So that gives me a cost of $531,000. Then to make my transaction balance, I'm going to book a loss here because it cost them more than what they expected of my cost minus what I had expected, so of $72,000. So this is my plug. This is the balance of the liability, and this is my actual cost. So now my 1-year warranty is done. We treated it. It's no longer like no one can come and say, okay, I want to use my 1-year warranty. It's due. Like, it's done. So now we go in and we look at my 3-year warranty. So now I'm going to start recognizing some revenue linked with my 3-year warranty because I'm going to start providing services for it. So here they're going to ask us to prepare all the journal entries in 2022 related to the extended warranties of 2021. So we want to recognize the actual costs in 2022 that the company had. And we also want to recognize some of the unearned revenue into warranty revenue for the year. So first, for the actual costs, it said that in 2022, it incurred actual costs associated with the extended warranty contracts that were consistent with what the company had expected to incur. So, okay, so their expectation of how much cost is gonna cost them over the 3 years is consistent with what they thought. So now we're gonna go and look at what did they think that they're gonna incur in cost. And it's this sentence here. So it thought that for the cost of the warranties, it thinks that 20% is going to be incurred in 2022, 50% in 2023, and the balance in 2024. So the cost that were incurred in 2022 is 20% of the total cost. So they should give us, okay. So we also have the cost for the 200 for the parts and for the labor for each contract. And we also have the number of contracts that were sold. So you're going to do a little calculation here. So we have my warranty expense. That amount is going to give my number of extended warranty contracts. So it's the 5,400 here times 20%, because there's 20% that was of cost that was incurred in 2022, times the cost per unit for the warranty. So the cost per unit is 240 plus 480. So that gives me a total actual cost for 2022 of $777,000. And we can also break it down for the actual cost for the parts and for the labor. So for the parts, it's going to be $540,000 times 20% times $240. And for the labor, it's going to be 540 units times 20% times the cost of $480 of labor. So just double check, my credit equals my debit, so I'm good to go. You could also went and just calculated your expense side and then plug it with your warranty expense. That's okay too. And then now I want to recognize my revenue. So you want to look at how is the revenue recognized. And here it says that S&T will recognize warranty revenues based on the proportion of costs incurred out of the total estimated cost. So total estimated cost is my 100%. And the proportion of cost is the percentage that are given here. So in 2022, there were 20% of costs, so they should recognize 20% of the unearned revenue that is set up in 2021. So I'm going to reduce my unearned revenue, and I'm going to recognize some warranty revenue. And that amount is going to be 20% of the 4.5 million that they had booked at the time of the sale. And that's all you're going to have to book for the extended warranty contracts in 2022. So you book your expense and you book your revenue. So you're good. Then they ask us what liabilities related to warranties will be reported on the December 31st, 2022 balance sheet. Show how these would be classified. So in your current liabilities, your warranty liability, this is for your 1-year standard contract, is now at 0. And that's because you set up your, in 2021, your expectation here, 900,000. It was reduced at the end of 2021 for the actual amount, and was also reduced in 2022 for the actual amount. So if I add these two up, it gives me my $900,000. So I have no more warranty liabilities. But I also have my unearned revenue, and that's for my 3-year contract. And that amount, there's still left over because I had booked in my unearned revenue at the beginning 4.5 million, and I just recognized for 2022 the $907,000. So what I have left in my statements is a 3.6 million that will be recognized in 2023 and 2024. Any questions for warranties? Did I go too fast? Anything you want clarification?
So Florence, going back to the warranty expense, the number 4.
Yes.
So you just did, why did you do 20? Oh, because it's 20% are being recognized for the cost. Because now we're thinking about the cost of the warranty. Okay.
And also because it told
Okay.
us that in 2022 that the costs, the actual costs were the same as what they expected. So if they said here that the actual cost was 30%, I would have recognized 30% in cost instead of the expectation here.
Okay. Okay, got it. Thank you.
No problem. So I'm going to move on to question 2. If you didn't have time to note everything, you can just let me know and I can go back at the end so you can take the answers down. So for question 2, it's about asset retirement obligation. The company DG Communications Inc. began as a small startup firm in the late 20th century, but in 5 years, it grew rapidly and expanded competitively into several areas of this industry. It is currently operating internationally, and its shares are listed on the NYSE. Its reporting platform is IFRS and has a fiscal year ending of December 31st. You now begin work on the file related to the obligation for asset retirement. in late 2016, it procured a permit to strip mine 1,000 acres of pristine land in the western regions of Saskatchewan. The provincial government had issued the lease free of cost as a grant to stimulate employment in this region. The company had earlier submitted a legally binding comprehensive plan, which included a timetable for the full reclamation of the land at the end of this lease. Although the permit is valid for 10 years from the date of the commencement of operations, the management is expecting to complete all its mining after 7 years. Once it has closed the mine, DCI will restore the land and ground cover to its original topographical condition, then provide restoration station, and finally encourage rehabilitation of pre-existing wildlife to the area. DCI will also engage in activities designed to minimize the air and water pollution created by the strip mining process. DCI has made the following estimates regarding the ultimate cost of the asset retirement obligation if the work was done currently. All relevant, oh my God, I can't talk this morning. All relevant labor cost estimates related to this reclamation work are currently $20 per hour. However, DCI is certain that this cost will increase by 10% by the end of the next 7 years and then level off. It would take approximately 10 hours per acre related to the restoration work on the soil, ground cover, and tree planting. Similar, the cost of equipment used for this work plus additional overhead costs is expected to be 75% of these labor costs. Other grass seeding and tree planting costs, seeds and trees estimated is $1,100 per acre. The company has not previously made any attempt to restore pre-existing wildlife, several bird species, garter snakes on its property investments. Based on conservative estimates, these costs have been pegged at $500,000 for this project. The company was legally obligated to complete all of the restoration work within 6 months of ending the mining operations. The estimates of the restoration work, points 2 through 4, were made based on current prices. However, to accommodate possible future price increases to when the work will be performed, the company expects to pay an additional 15% of the restoration estimate described in points 2 through 4. The initial investment to set up the plant and equipment in order to commence the mining work was estimated to be $21 million and was classified as asset landmine. The plant was scheduled to be set up and paid for in 2017, and the production was scheduled to commence on January 1st, 2018. A discount rate of 4% per annum was considered to be realistic. And finally, the company will account for the error from the date of the commencement of the production process. A lot of information in this problem. What's different in this problem than I think other problems that maybe you have practice for is we have to calculate what the error cost is. So we have estimations of how much the labor is going to cost, of how much it's going to cost them to plant those seeds, of how much it's going to cost them to conserve, to bring back the wildlife to the habitat. So we're going to have to calculate that. And yeah, so that's the little tricky part of this problem. So if we check the first requirement, first of all, it's under IFRS, so keep that in mind. And the first one is to record the transaction listed below. So we have to figure out what's the cost associated with the asset restoration obligation on January 1st, 2018 and construction of the plant in 2017. Be sure to include a detailed breakdown of your computation of the restoration cost. So what's going on here? So they are mining, and they're mining on a land of 1,000 acres. And they said that they are gonna restore the land and ground. They're gonna provide reforestation and encourage rehabilitation of wildlife. They're also going to engage in activities designed to minimize the air and water pollution, but that's going to be like throughout the project. So at the end, they're going to have to pay this. They're going to have to figure out how much they're going to have to pay to do all these actions at the end of the project. So first, they tell us that all relevant label cost estimates related to this reclamation work are currently $20 per hour. So here, if I put the reclamation of soil, ground covers, reference 3.3. So this is my labor cost that I'm trying to figure out. So they say that it's gonna be $20 per hour. They think that that cost will increase by 10% by the end of the next 7 years. So I'm going to do $20 per hour times 1.1 to account for the increase of 10%. They think it's going to take 10 hours per acre. So I'm going to do 10 hours, and the number of acres is here. So the land has 1,000 acres. And then it says here that the cost of equipment used for this work plus additional overhead costs is expected to be 75% of these labor costs. So I'm going to do all of this times 1.75. So I have my 100% for the labor related to the reclamation work, and I also have the 75% for the cost of equipment. So that gives me a reclamation cost of $385,000. So what I did is the $20 per hour times the increase of 10%, times 10 hours per acre, times 1,000 acres, times 1.75. And then we have the grass seeding and tree planting costs, and that's going to be at $1,100 per acre. So 1,100 times 1,000 acres. Oh, yeah. But then in point 6, it says that for points 2 through 4, it expects to pay an additional 15% of the restoration. So I'm going to do this amount times 1.15 because it's going to be increased by 15% throughout the project. And then for the conservation of wildlife, it's going to be $500,000 for the project. I mean, they say restoration. So it's going to be $5,000 times also the 15%, because throughout the project, they think that they're going to have to pay an additional 15%. So 575. So that gives me a total of $2.225 million. 2.2 million. So that's your arrow, but that's your arrow that you're going to have to pay at the end of the project.
Florence, is it possible that the labor, what's point number 2?
Yeah.
Sorry, the restoration, we have to add 15% to that as well.
No,
Did you do
because they
that?
said here that, oh,
0.224, that's why.
yeah, you're right.
So I did it separately, the I guess the equipment cost, and it's 165, and then multiply 1.15, I believe.
Okay. Oh, okay. You're right. I think. So here's the equipment, cost of equipment. So because in point 6 it says that the 15% increase was for points 2 through 4, the
Four.
cost of the, yeah, so the cost of the equipment is going to be also increased by the 15%. So
15%.
I'm going to do 75% of the amounts I calculated here times 1.15. Is that what you did?
No, I got, maybe I didn't do it properly, but I got, so the cost of labor is 220,000. And then 75% of 220,000 is 165 times 1.15, which is 189.
How did you get your 200,000 of cost of labor?
Because it's 75% of the 385, right?
Yeah.
Oh, you did 75% of
Oh,
that?
sorry, it's, yeah. So it's 75% of this amount here, because here it says that it's 75% of the labor cost. And I
okay, so then
115 for the increase of the 15%.
Okay, then I must have missed a number, because you did $20 times 1.1 times 10 hours times 1,000 acres and got 385.
Exactly.
Oh, but is it possible that your 385 has the equipment still in there? Like if you click on your cell,
Oh, you're right. You're right. Thank you.
because I think it's yeah.
There.
Okay.
We
Okay, that makes sense.
Thank you.
Of course. Okay, so 570 for wildlife.
Okay, so did everyone follow the other 6 people? Hopefully you did. So that's the arrow that you're gonna have to pay in at the end of the project. So on January 1st, 2018, what's going to be the journal entry? You're going to have the cost for your 21 million of your landmine that was here. You're also going to have to present value that amount and add it to your asset. So you're going to have your asset landmine for 21 million. That's the cost of the asset. So that's as if like you bought a building for your 21 million, but now it's just a landmine. Then you're also gonna have your asset landmine, and that's gonna be the present value of your arrow that I'm gonna calculate just in a little bit. They paid cash, I'm assuming, for that landmine, so I'm just gonna do credit cash. And then you're also gonna have your arrow that's gonna be the same amount as this. So to calculate these amounts, we want to find the present value. So we know that my future value is the 2.2 million here that we calculated earlier. We now need to find how many years the project is going to be for, and we also need to find the discount rate per year. So it says that the project was for 7 years. I'm just trying to figure out where it said that.
The second paragraph, it says, although the permit is valid for 10, From the date of commencement of operations, the management is expected to complete all of its mining after 7 years.
Exactly.
Yeah.
Thank you. So since they expect to finish it in 7 years, that's the number of years that you're going to use for your present value calculation, even though they could finish it in 10 years, because that's what the contract asked them to do. But here you're not looking at what contractually when the project is done, you're looking at when they're expecting it to be done, because it said that the cost needs to be paid within 6 months of the end of the mining operation. So you know it's going to be paid at the end of the project when they're done actually land mining, whatever they're doing. So it's going to be paid out in 7 years because they're expecting to be done with the project in 7 years. And the rate normally is just given, it's 4% per year. So I think in your exam, you're going to be given like the little like table for present value. If you have a financial calculator, you can also use that to calculate it. The difference is not big enough for them to remove any points, but I would suggest like putting like what's the future value that you put, what's the number of period that you put, and what's your rate that you used, just so they can see that you use the right values in your calculation. Is 4%, number of period is 7, there's no payment, and future value is the 2.2 million, and it's at the end of the period. So that gives me a present value of 1.7 million. And that's what I'm going to increase my asset by, and that's when I'm going to recognize my arrow back. So that's the transaction that they set up on January 1st, 2018. Then they ask us for the annual depreciation expense on December 31st, 2018. So how you calculate a depreciation expense, I think it has been drilled into you now, but it's the cost of your asset divided by its useful life. So the cost of the asset is your 21 million plus the present value of the asset retirement obligation. So that's 22.7 million. And the useful life is the 7 year here, because it's going to be done in 7 years. So my depreciation expense is 22.7 million divided by 7 is 3.2 million. So then my journal entry is depreciation expense to accumulated depreciation for the landmine, and it's just going to be this amount. Then they're asking us for the finance cost on the outstanding liability for the year ended December 31st, 2018 and 2019. So that's your interest expense for your arrow. So to increase it to get to 2.2 million. So on December 31st, 2018, my interest expense to arrow is going to be my rate here times my arrow balance that we booked here, 68. Let me know, guys, if you get different amounts, because my solution was wrong because of the cost of equipment. So if you get something else, and it might be on my end too.
Sorry, Florence, can you just re-explain how you got the interest expense, please?
Yes. So when you're calculating your interest expense, you're taking the book value of your asset retirement obligation times the interest rate, which is 4%. So I did the 1.7 million times 4%. but that's for 2018.
Because it's just the ARO in itself.
Exactly. In
Right, because we're paying interest on that. Okay.
Exactly. In 2019, my ARO balance has changed because of that 68,000 here. So in 2019, my ARO is now 1.7 million plus my 68,000 here. So now my balance is a little bit higher. So my interest expense is now going to be 4% of this amount here. And then in 2020, my ARO balance is going to be a little bit higher, so my interest expense is going to be also a little bit higher.
And the ARO wouldn't have been affected by the depreciation of the whole asset?
No, it doesn't. It doesn't get, because your depreciation, how it's calculated, it only impacts your depreciation expense and your accumulated depreciation.
Even if it's calculated based off of the ARO amount plus the initial acquisition cost?
Yeah, because
Okay.
when you're calculating your depreciation, it doesn't increase the cost of your asset. It comes and
Correct.
reduce it with your accumulated depreciation, but it's in a separate account, a separate line in your statement.
Okay.
This is under IFRS. They're asking us what it would have been if it was under ASPE, and it's exactly the same calculation. But now, instead of interest expense, it's accretion expense. That's the only difference. And I don't know why they really make it a point that you know that it's accretion expense for ASPE and interest expense for IFRS. So just keep that in mind while doing your problem at your midterm, because I don't know why they're so like, it's just one word and they mean the same thing, but put it in your head, it's accretion expense for ASPE. Then for requirement E, assume that it is time for DCI to shut down its mining operation and to dismantle the erected equipment at the end of its 7-year life. On January 1st, 2025, DCI issued 3,000 5-year 6% bond, par value $1,000 to Environmental Engineers, Inc., a restoration company, as compensation to undertake and complete the required restoration work. Prepare the required journal entry in proper format to record this transaction, given the market interest rate on the date of the issue of the bond was 7%. So here they're not paying cash, they're issuing bonds. So you're gonna have to figure out what's my book value of my bonds on January 1st, 2025. So that ties in a little bit of chapter 14. So just like a preview for what we're going to do in a few minutes. So you're going to want to find what's the present value of my bonds. So I know that my future value is going to be the 3,000 bonds, number of bonds, times their value of $1,000. Sorry, it's 3 million. Then my interest rate is the market interest rate on the date of the issue of the bond was 7%. The number of period is 5 years, because the bonds are issued for 5 years. And then my payments are computed with my 6% coupon rate. So it's going to be 6% of my future value of 3 million. So my present value is $2.8 million. So I have an arrow in
And
my
this,
yeah.
sorry, Florence, the 2.876 million, that's the present value of the entire bond, the principal and the annuity?
Yes. So when
Okay.
I'm using my formula in Excel, the annuity is
Yeah.
using the payment of 180. So
Okay.
I think if you're using, I never use the little schedule that they give in the exam.
Yeah, I'm just
Like,
using the calculator. So I would do the principal, then I would calculate the annuity and then add them together and I should get 2.8.
yeah, exactly. But with your
Okay.
calculator, you should have a little button that says payment also that you can just put the 180. But if you're more used to doing them separately, you can do them separately also. Just do what's more.
I should know that I could put it all together. Okay, I thought I always had to calculate it separately. That makes sense. Okay, I will try that then.
Yeah.
Thank you.
No problem. So, so that's the actual cost, right, of the arrow, because that's what they're paying to the engineers. So they had set up an arrow that by now should be at my 202.2 million, because it's been 7 years, so all the interest expense has been added up. It doesn't say that there was a change in estimate, so there's no like it should be at 2.2 now in the account, right? Because over 7 years they added the interest expense, it gets to 2.2. Then they have the issuance of the bonds variable, and that's for the 2.8 here. So now there's a difference between the two, and that difference is going to be booked as a loss on asset retirement, and it's just going to be the difference between the two. It could also have been a gain if they paid less than their arrow. It just depends on what the value you get. Okay, sorry. For section F and G, so for the last two requirements, assume that the company estimates that an additional future restoration cost of $148,000 occurs as a result of production activities during 2019. This additional cost is associated with the use of the equipment installed at the tracking station and is to be accrued and recording at the end of 2019. So we're going to record this transaction only under IFRS and ASPE. So here it's like your variable costs. So that's your costs that are based on what was the production during the year. Under IFRS, it's booked in manufacturing overhead, and it decreases the arrow. And under ASPE, it increases your assets. So this is going to have an impact on your depreciation expense because now it has been increased by that by the production activity amount. But it also increased your arrow just like in IFRS. So the amount is 148,000, but it's 148,000 that they're going to have to pay at the end of the project. So we have to present value it again. So PV, my future value is 148,000. My my interest rate is still 4%. The number of period, just one moment, I have someone ringing. Okay, so my number of period, we're in 2019 right now. So that means that 2 years have already passed. So 2018 has passed and 2019 has passed. The total length of the project, we said, was 7 years. So I'm going to discount it on the leftover 5 years. FEKN, there's no payment. So my present value is going to be rate of 4%, number of periods, payment. So the present value is going to be $121,000. So this is what I put here. That's for F. For G, it asks us to determine the annual depreciation expense amount to be reported on December 31st, 2020, so a year later, for IFRS and ASCII. So when you have like production costs like that arise during the year, the effect it's going to have on your depreciation expense is only going to be in the next year. So in 2019, my depreciation amount would have been the same as in 2018, so the 3.2 for IFRS and ASCII. In 2020, there's going to be an impact for ASCII because the production cost impacts my asset account. So I'm going to want to increase my depreciation to account for the 121,000. IFRS, there's no difference. My amount is still the 3.2 million because my transaction affects manufacturing overhead. It doesn't touch my asset account. Under ASCII, you're gonna still have the 3.2. So that's your initial asset here of 22.7 million. So like we calculated earlier, but you're also gonna have to depreciate the 121,000 over 5 years because there's only 5 years left. So it's not going to be over 7 years like we used to calculate this. So that amount is going to be $24,000. So my total depreciation expense is going to be the 3.2 million plus my 24,000. So it's going to be 3.268 dollars. All right. Any questions for asset retirement obligation? Anything that's not clear? Okay. So I'll move on to payroll. You're not going to have a long question on payroll. It's most likely going to be in, if there's still a multiple choice question, it's going to be in your multiple choice questions.
Our midterm is actually all multiple choice.
Okay, so it's like how I did it. So in your multiple choice, you're going to have a section that's like short multiple choice. And you're going to have a section that's like long questions, like for example, a arrow question, where all of these requirements are going to be a multiple choice. So here you're going to have like different costs it could have been. Here you're going to have different journal entry could have been. So with different amounts. So you could, like, if you have no clue what the annual depreciation expense, if they put like a journal entry that doesn't even affect depreciation expense, then you can already like cross it out kind of and go by elimination. But so that's how it is. Like you're still gonna have one question like this in your, it's just that it's gonna be broken down in multiple choice answers. So for payroll, Trans Montreal Inc. has recorded at $360,000 as payroll expenses for September 2018. The company and its employees each pay Social Security taxes at a rate of 6.5%. Payroll income taxes average 22% for federal and 16% for provincial and local taxes. Both are also responsible to pay for Medicare taxes at a rate of 1.65%. The federal unemployment taxes are payable by both employees and the company at a rate of 3.85%. The provincial unemployment tax rate is differently applied. A rate of 2.4% is applied on each employee's earnings up to a maximum monthly wage base of $6,000 per employee. The monthly earnings in excess of this $6,000 wage base are exempted from the tax. The total earnings not subject to provincial unemployment tax for September amounted to $140,000. The company pays the provincial unemployment taxes at the same rate on the total amount of the monthly payroll expense. Trans-Montreal has agreed to deduct union dues at a rate of 2.1% and implement it to the company's union. All of the percentage rates are to be applied on the gross monthly payroll amount. The remaining wages, net of all deductions, are then directly credited to the employee's bank account. Payroll, they're giving you like so much information that it's easy to miss one. So how I do these type of column is I just do it like line by line. Okay, they have a 360 payroll expense for September. I go and put in my 360,000 payroll expense in my journal entry. They're gonna ask you to prepare the journal entry to record the monthly payroll. So that's like what's deducted from the employees. What the company payroll tax expenses for the month. So that's what the company pays on top of what the employee had already paid, and then the payment. So first, if I do like the employee portion, also in practice, the employee and employer portion are normally just like done together, just so you know. So the employee portion, you're gonna record the payroll expense, which is salaries and wages expense. It could be just salary expense, could be just payroll expense, and not payroll expense, salary expense, wage expense, salary and wage expense. So that's the gross amount of salary that the employee has earned. So that's my $360,000 for the month of September. Then, if I continue, it says that the company and its employee each pay Social Security taxes at a rate of 6.5%. So my Social Security taxes for the employee portion is 6.5% of my gross amount here of 360,000. I used the 360K because they said here that the percentage rates are to be applied on the gross monthly payroll amount, but also this is like, for example, when you look at your pay slip, you see, okay, I earned like, I don't know, like $500 for this last pay period, but there was all these deduction, and then I get my net, and that's what you actually cash in your account. So all these deductions are based on the amount of the $500 that you actually like worked for. So I have my Social Security taxes, the employee portion, and I'm also going to do at the same time the employer portion, just so I don't miss anything out. Employer. Here, the company also paid a 6.5%, so I'm just going to put the same amount. Then it says that payroll income taxes average 22% for federal and 16% for provincial and local taxes. So income taxes, federal, and income taxes, provincial. So for federal, it's 22% of my 360,000, and for provincial, it's 16% of 360,000. I don't have an employer portion because this is like your payroll, your income taxes that you're gonna have to pay at the end of the year. That's just paid a little bit in advance, so you don't have to pay a big amount. Comes when you do your tax declaration. So the employer doesn't have any portion of income taxes to pay.
They just function as like a pass through, correct? So they just withhold it and then every quarter remit it to the government?
Yeah, exactly. Just so you know, just for your knowledge, it can be, normally it's remitted either every month. If you're a small business and you have less employees, it could be every quarter.
Okay.
But basically they put it aside and then pay it to the government whenever like they have the due date of payment. Then there's also Medicare, and they're both also responsible to pay it at a rate of 1.65%. So that's going to be 1.65% of the 360,000. And same amount here. Then they say that the federal unemployment taxes are payable by both employees and the company at a rate of 3.85%. So that's employment insurance, federal for the employee. And that's 3.85 times the 360K. And it's going to be the same thing here, 3.85. Then it says that the provincial unemployment tax rate is differently applied. A rate of 2.4% is applied on each employee's earning up to a maximum monthly wage of $6,000 per employee. The monthly earnings in excess of this 6,000 wage base are exempted from the tax. The total earnings not subject to provincial unemployment tax for September amounted to $140,000. So this is for the employee portion. This is for the company. The company pays the provincial unemployment tax rate at the same rate on the total amount of the monthly payroll expense. So basically what they're saying is that the employee only have to pay for unemployment insurance if they make up to 6,000 gross salary for the month of September. If they do not, it's not going to be applied to them. So to find out how much of the employee in total are actually going to have to pay, they're giving us here that there was $140,000 in salaries that were exempted from that rate. So since I have my total salary minus this, I'm going to be able to find what my amount of salary that's eligible for provincial unemployment for the employee part, and do that amount times the 2.4. So if I re-explain, I do my $360,000. So that's my total amount of salaries for the month of September, minus $140,000. So that is the amount of salary that is exempted from the 2.4%. So that gives me the amount of salary that is going to get the 2.4% as a deduction, and then times 2.4%. So that's 5,280. For the employer, it said that the company pays the provincial unemployment taxes at the same rate on the total amount of the monthly payroll expense. So that means same rate, they use 2.4%, total amount of the monthly payroll expense, that's my 360,000. So here, all we're gonna do is 360,000 times 2.4%.
So Florence, if they give us all of these percentages, we just kind of like, we don't apply any of the ratios that we usually have in the from the actual theory, like the 1.4 for I think it's Canadian pension, or 1-to-1, or EI
Yeah,
1.4?
so these ratios are the actual ones for the year of 2023.
Okay.
I think it would be good to know, just in case, what I've seen from
Okay.
from the midterms that I've seen. Normally they give you the percentage, but if they don't give you any
Correct.
percentage, then use the ones that you saw in class, which are the actual ones for 2023.
Okay. Okay. Sounds good.
Then Transmetro has agreed to deduct union dues at a rate of 2.1% and remit it to the company's union. So this is only for the employees. So again, they're just like a transmitter. They're taking the payment from the employees and they're just giving it directly to the union, a little bit like how it was for the income taxes. So that amount is going to be 2.1% of the gross wages. And then that's it. So that's my employee portion journal entry. And then for the employee portion, all we're missing is the payroll tax expense, which is just a sum of all the amount that we calculated here. And lastly, they're going to ask us to prepare the journal entry to pay. Oh, thank you. I am missing cash. So that's like the most important part too for employees, right? So the cash amount that was actually paid to the employees is $167,000. And this is just a plug. And this is also just a plug. So then, now we're going to prepare the journal entry to pay all the liabilities for the accrued salaries. So here you paid the net salaries. You didn't pay any of these amounts yet. So now we're going to prepare the payment of all these amounts here. Okay. So I'm just going to copy all of this here, because here also I didn't add, but at the end of all these lines, add like payable, because they're not paid yet. So now add here all payable. So now you're going to pay them. So you're going to reduce the amount of payable that you owe. So you're reducing your current liabilities. And then your credit is going to be cash because you're paying that cash. And then here, all you're going to add is all your amounts together. So Social Security taxes, employee and employer. Income taxes, it's only the employee. Medicare is employee and employer. EI, employee and employer. And then union dues, it's only employee. And then total amount is $244,000. So that's the payment that you're doing to all these different organizations for your employee and employer contributions. We're still on chapter 13. We have three questions left in chapter 13, and then I think we're going to take a break, maybe like 30 minutes. And we can come back after. Chapter 14 and 16, there's less like different types of problems, so it goes a little bit quicker. So next question is on short-term debt refinancing. You learned that DCI has a 5 million notes payable outstanding. The terms of the notes require repayment of principal on June 30th, 2022. The company is now finalizing the financial statements for the year ended December 31st, 2021. In January 2022, before the financial statements are released, the company comes to an agreement with the lender to refinance the liability, with the new due date being June 30th, 2025. DCI also has committed to donate, it's supposed to be $200,000 to support the Provincial Snowboarding Association race programs for the year. I'm just going to finish reading. No donation agreement has yet been signed, but a public announcement has been made, and the company and the Snowboarding Association have met and agreed that the funding supporting the races for the season and promotion by DCI will be publicized through the association's website. So to answer your question, if the majority of questions on your midterm will be on chapter 13, well, there's a lot of more different scenarios in chapter 13 than there is on chapter 14 and 16. But your chapter 14 and 16 will be evaluated in long questions. So it's going to be longer. You're going to have more multiple choice answers for the problems than, like, you're going to have your long problems. There's definitely one on chapter 14. There's definitely one on chapter 16. Then your other long problems, I don't know how many they said there was going to be, or if they even said it. Normally there's one on ARO, asset retirement obligation, or and on warranties or premiums. The rest of chapter 13 is going to be tested as short multiple choice questions. Then chapter 14, you're going to have a long question on bonds payable. It's either where you're going to have to do all the transaction, or you're going to have an amortization table where there's going to be some amounts missing and you're going to have to figure out the rates, like what we're going to do in this video. And then for chapter 16, normally it's mixed a little bit with bonds payable because warrants and conversion of bonds are linked with bonds payable. So you're going to have a long question on that, and you're going to have to do journal entries. That's what I've seen the most. Again, they might like switch it up and change it up. I'm not in contact in any ways with the teachers, so I don't know. But from just like the past midterms that I've seen, and I've seen a lot, that's how it goes normally. No problem. So for short-term debt refinancing, they're going to ask us if DCI complies with IFRS, will the note payable be classified as current or long-term? If DCI complies with ASPE, it's going to be classified as current or long-term. So under IFRS, so first I'm going to do my little timeline. My year end is December 31st, 2021. My financial statements release, we don't know. They're not telling us when they are released. But they're telling us that in January 30, 2021, which is before the financial statements are released, there was a refinancing agreement. And the new due date of the new agreement is in 2025, so that's long-term. Refinancing agreement is long-term. So, because my refinancing agreement was done prior to my financial statement release, under ASPE, I'm going to start with ASPE. Under ASPE, the 5 million note payable outstanding can be classified as current. Can be classified as long-term because it was done using a long-term terms. So this is going to be classified as long-term, but they're not telling us how much it was refinanced for. So now we're just assuming that the whole 5 million was refinanced, so the whole 5 million can go in long-term. But if in your midterm it says that the refinancing agreement was only for $3 million, you could only put the 3 million as long-term, and the balance of 2 million would be classified as current because that 2 million is going to be paid within the year. Under IFRS, there's no unconditional rights to defer payments beyond 12 months as of December 31st, 2021, because the refinancing was done in January. On December 31st, there wasn't any indication that there was going to be a refinancing that was going to be done. So as of December 31st, they're going to have to pay the 5 million notes payable in the next year. So under IFRS, it's going to be classified as short-term. Then for C, if DCI complies with IFRS, will the $200,000 amount be recorded as a liability? Explain. So this is not linked with short-term debt refinancing. It's more like classification of liabilities. So there's no legal obligation for them to pay the $200,000 because no donation agreement has yet been signed. So it's not a legal obligation. But it is a constructive obligation. It is a constructive obligation because there was a public announcement that has been made. The company and the Snowboarding Association have met and agreed on the funding supporting the races for the season, and promotion by CI will be publicized through the association website. So even though they didn't sign anything, all their actions, all DCI's actions, show that they're going to have to pay the $200,000 to support the Snowboarding Association. So they're going to have to record in their books as a liability. So it can be recorded as like donation payable or something like that. The current long-term classification doesn't really matter in this case. So it could be current, it could be long-term, because they don't really say a due date. This is short-term multiple choice questions for sure. Short-term, short answer multiple choice question. Then for contingencies, early in January 2017, a customer fell on an icy path on the parking lot of the Boutiques Inc. and broke an ankle. A month later, the customer filed a lawsuit against the boutique. The company referred to the case to its attorneys who, after conducting an extensive review of the available evidence, were of the opinion that it's likely that the boutique will lose this case, approximately 75% probability. The attorneys presented the boutique with their assessment of possible loss outcomes along with the estimated probabilities as follows, but refused to provide a point estimate, saying that with this estimate, no one amount is that much more likely than any other to occur. Then we have all the different amounts that they could pay with their probabilities. Explain in reasonable detail how the lawsuit should be reported if the company was using ASPE for financial reporting. Determine the amount of the liability, if any, to be reported, and prepare the relevant journal entry if required to record such a liability. So, under ASPE, what we're looking for is more than likely. No, sorry, it's just likely. So it's a 70% or higher probability that they're going to have to pay it. And since here they say that there's a 75% probability, then this is checked out. Yes. And 2 is, can the amount be reasonably estimated, either by a point estimate or a range? And yes, because we're given a range here. So what they're going to book is a contingent loss for injury claims and a contingent liability for injury claims. We do not have a point estimate, so we have a range. Under ASPE, when we have a range, we're going to book the lower of the range, and the rest of the amounts that are probable are going to be disclosed in the notes. So they would book $400,000 as a liability and a loss. Under IFRS,
So sorry, Florence, in this case, it just the lowest range, sorry, the lowest number provided, no matter if the probabilities are like 50 or like the 500,000 has an 8% probability. It's just always the lowest amount.
yeah, it's always the lowest amount.
Okay.
Because ASPE, it's less rigorous than IFRS, because normally ASPE
Mhm.
is used by private companies. So
Right.
because this amount is not like real yet, it's not probable, they're just going to disclose the lowest, and then the rest, they disclose it in the note. The users know that there's a lawsuit and it could increase, but they just put at the lowest. Under IFRS, it's more rigorous. You calculate like the average of all these amounts. So under IFRS, it's the same criteria, except here it's more than likely. It's more likely than not, sorry, more than not. So that means 50%. And it's a yes again, because it was 75%. And can the amount be reasonably estimated? It's a yes again, because we have a range. So under IFRS, it's going to be a loss on injury claims and provision for injury claims. Contingent liabilities, that word doesn't exist in IFRS, it's provision. Mean the same thing. So it's going to be $400,000 times 15% plus $420,000 times 21 plus $440,000 times 30 plus $460,000 times 16 plus $480,000 times 10%, and finally $500,000 times 8%. 415. In both cases, there's more stuff that they also disclose in the notes, but it's not going to be asked for you guys to know what they need to disclose in the notes, except for the part in ASPE where they have to disclose the rest of the range. I think I put it in the PowerPoint if you want to look, but that's it for contingencies. Then premiums program. Corn Corporation started a premiums program in order to increase the sales of its breakfast products. It offers a digital memory stick to customers who submit 3 coupons obtained from the purchase of their product, winner cereal, along with $150 in cash. The company places 1 coupon in every box of cereal that it sells. The company sold 1 million boxes of cereal for $4.50 per box in 2017. It also purchased 100,000 memory sticks in 2017 for $2.25 each and paid for them in cash. It estimates that 10% of the sales amount received from customer relates to the premiums program of the awarding of the memory sticks. Premium revenues are recognized based on the proportion of costs incurred out of the total premium cost estimated. It further expects that 36% of the coupons placed in the cereal box will be sent in for redemption. In 2017, 240,000 coupons were redeemed. Corn Corporation follows IFRS and uses the revenue approach to record all its premium programs. So first, they're asking us to prepare the journal entry in proper format required to record the purchase of the memory stick. So you're going to have your premium inventory and cash or AP. So they bought 100,000 memory stick in 2017 for $2.25. And that's it for requirement 1. Then for 2, prepare the journal entry required when the cereal boxes were sold. So they use the revenue approach. So we have to book an unearned revenue. And the unearned revenue is going to get recognized as premium revenue when they actually give out the premiums. So I'm going to have my cash. I'm going to have my sales revenue, which is for the cereal boxes. And I'm going to have my unearned revenue, which is for the premiums. The cash amount is 1 million boxes times $4.50 here. That's my cash amount. It says here that it estimates that 10% of the sales amount received from customers relates to the premium program of the awarding of the memory sticks. So 10% of the 4.5 million is for the premiums. So that means that 90% is for the cereal boxes. Then for requirement 3, determine the amount of premiums, promotion revenue, and expenses which the company will report on its 2017 income statement. So they want to figure out what's my premium revenue and what's my premium expense for 2017. So first we want to see how many memory sticks were redeemed. That's my actual. So it said that in 2017, 240,000 coupons were redeemed. And it takes, how many coupons does it take to get a premium? It takes 3 coupons. So that means that my number of premium is, like of memory sticks that were awarded, is the 240,000 coupons divided by 3. So that gives me the number of memory sticks that were actually redeemed. Then for my expectations of how many were going to be redeemed, we have to look at how many coupons were bought during the year. How many does the company think that are going to be redeemed? And then divide that amount by 3 to get to our premium amount of expectation that is going to be redeemed. So during the year, there was 1 million boxes of cereals that were sold. And each boxes of cereal has 1 coupon. So that means that there was 1 million coupons that were bought during the year. Then the company thinks that 36% of the coupons will be sent in for redemption. So they think that there's going to be 360,000 coupons that are going to be redeemed during the year. And that makes it to be 120,000 memory sticks. I divided it by 3 because it takes 3 coupons to have the digital memory stick. So I have my expectation, I have my actual. So now for my premium revenue. Oh, okay. So to find my premium revenue, I'm going to see how much of my expectation was redeemed. So my 80,000 divided by 100,000, 120,000. So 67% of my unearned revenue was redeemed. So that's going to be 67% times my 450,000 here. Then for my premium expense, it's going to be $821. It's going to be the number of premiums that was redeemed times the unit cost of those premiums, which was $2.25, minus $1.50, because to get the premiums, they have to submit 3 coupons and they also have to pay $1.50. So the cost is going to be reduced by that. So that means that the premium expense is actually $60,000. So that gives me a net revenue for the premiums of $240,000. Then for the balance sheet, that's the part 4 in 2017. Determine the amount of any liability arising from the premiums program and show how the company will report this on its balance sheet. So we only have unearned revenue as a liability. And that unearned revenue that we set up at the beginning, which was 450,000, is reduced by 300,000 for the actual premium revenue that was recognized in 2017. So that leaves us with 150,000 as unearned revenue that would be recognized in future years. Any questions on chapter 13 in general? Because after that, we're moving on to chapter 14. Okay. Do you guys want to take a break, or do we push through into chapter 14 and 16 right now? The problems are, they're long problems. I'd say that maybe an hour still of tutorial to finish everything, to the theory for both chapters and to do their problems. Break? Okay. We'll take a 30-minute break. So come back at 12:40, 12:45. No, let's make it 12:45. So I'll see you guys then. Have a great break. Okay, so chapter 13 was more on short-term liabilities. Now we're more looking at long-term liabilities, but more specifically bonds and notes payable, because other types of long-term liabilities like pensions and leases will be covered during your final exam. So bonds are a way for companies to borrow long-term for a large amount of money that is too big for just one bank to give out. So for example, if they need $50 million and the bank says, okay, I don't really want to lend you $50 million, then the company can issue bonds. And so that $50 million is going to be divided up by a bunch of bondholders, and the company is going to repay the $50 million with a little bonus interest if there's one. And a note payable is more like your classic debt with the bank, where it's just one one lender. So there's two ways to record bonds and notes payable. There's the effective interest method and the straight line method. Effective interest rate method is allowed under IFRS and ASPE, and straight line method only under ASPE. Bonds can be issued at par, at a premium, or at a discount. To know if they're issued at any of those three, you have to look at either the coupon rate and the market rate, or the issue price and maturity value. Coupon rate is the rate that's on the bond contract. That's the amount of money that at every period the company is going to pay to the bondholders. Market rate is the rate of the market. So that's what's going to be used by the company to calculate their interest expense. Issue price is the present value of the bonds. So that's the at issuance, at how much you're going to record the bonds in their books. And the maturity value is the future value of the bonds. So if the coupon rate is greater than the market rate, is going to be issued at a premium. So the issue price right now is going to be bigger than the maturity value. So at every period, they're going to come and reduce their bonds payable to get to the maturity value because it's lower. Whereas if it's issued at a discount, your coupon rate is lower than your market rate. So your issue price is going to be lower than your maturity value. So at every period, you're going to add to your bonds payable account to get to your maturity value. Best way to solve these type of problems is by doing an amortization table. In your amortization table, you're going to have the dates of all the periods, payment periods. So if payments is paid twice a year, every 6 months, you're going to be putting your 2 dates here. If it's paid 4 times a year, you're going to put your 4 dates here. Cash is based on the maturity value and the coupon rate. So that's what at every period they're going to give out to the bondholders. So it's the maturity value. So the book value of your bonds payable at the end of the terms times the coupon rates, which should be given to you, divided by the number of payments per year. Your interest expense is going to be the book value of the bonds payable of the previous period times the market rate divided by the number of period per year. And the difference between the two is going to come in your amortization, and that amortization portion is what's going to impact the book value of the bonds payable. So here, when bonds are issued at par, this and this are going to be equal because it's the same coupon rate. It's the same rate, so the coupon rate is equal to market rate, but also your maturity value and your book value, which is like your issue price if you want, is also equal. So this at the beginning and this at the end is equal. So there's no amortization, it doesn't change. All you're booking is an interest expense that is equal to the cash disbursement. If it's issued at a premium, you're going to have a greater amount of cash than interest expense. And that difference is going to come and reduce your bonds payable. And if it's issued at a discount, your cash is lower than your interest expense. So it's the difference between the two is going to come and increase your bonds payable to get to your final value. This is for the effective interest method, and that's what you're going to be probably using in your exam. But there's also the straight line method. And the straight line method, how it works is you're going to calculate your cash payments as normal using the coupon rate and the maturity value. But the amortization amount that's going to be here is only going to be the difference between your issue price and your maturity value at the end. So you do maturity value minus issue price, that gives you a number, and you do that number by divided by the number of periods that you have in your schedule. So that's going to give you the amount of amortization that's going to be booked each period. And then the difference between the two, that goes in, well, the amortization amount goes in your balance payable, and the difference between the two is going to be your interest expense. So these are the type of entries you're going to do under the straight line method. A debt can, when a debt is done or when a debt needs to be removed from the financial statements, it's when the company pays back the bank, for example. So at the end of the terms, they paid it all, the debt is completely removed from the financial statements. Or if the company cancel, like the debt contract, the bond contract gets canceled or expired, then they're released from their obligation to pay back the creditor. So you're gonna just remove the debt from your book by debiting the bonds payable of its net carrying amount. So you're gonna have to calculate the interest expense and the cash expense up to the date that it gets derecognized. And there might be a reacquisition price. So if there is one, you're gonna book that. And the difference between the two is gonna be a gain or a loss from extinguishment. There can also be some times where the company realized, like, okay, I'm not going to be able to pay back my debts to the bank. So they go to their bank and they say, hey, can we change the terms of the debt contract so I could pay it back? That can either be by changing the length of the term. So if it was due in 5 years, maybe they can extend it to 15 years. It could be done by changing the interest rates. Could be done by changing the principal amount that is owed. So there's a bunch of different circumstances that can affect how the debt would change. And that's only if the bank agrees. The bank can also decide to settle the debt right now at a lower price than what the company would have paid if they continue with the normal terms. So if they settle the debt, so if they pay it earlier, the old debt and all its related discount premium and issuance costs will be removed from the debit from the company's books. And again, will usually be recorded because you're usually paying lower than what you would have been because you can't pay what would have been. You can't pay all the amount, so you're paying lower, so you're going to book a gain. And on the bank side, they're going to remove the loan receivable, and they're probably going to recognize the loss because they're now receiving less than what they had anticipated. To settle the debt, it can be done by cash, but they can also transfer non-cash assets like receivable, like buildings, like PP&E. They could issue shares. And they could get a new debt with another bank, for example, and use the cash they get from that debt to pay back their current debt. If non-cash assets are used, the company will recognize a gain or loss on disposal of the asset, like you saw in ACCO320. So they have to remove the asset from their book, the accumulated depreciation. And if the shares are used, the market value of the shares is compared to the book value of the debt, and the difference between the two is going to be booked as a gain or loss. If it's a modification of the debt terms, like I said, it could be like a bunch of different things that modifies the terms. But you want to look for it if it's a substantial modification. So if it's really big changes that affect the debt by a lot, it's going to be seen as settling the old debt and issuing a new debt. And to know if it's substantial, what you want to do is find the present value of the new terms using the old interest rate And you want to see if it's at least 10% different than what you have currently in your books. So the present value of the old debt. If it is, it's going to be considered as substantial change. Or another option, but that's less quizzed on your midterm, is if there's a change in creditor and the original debt is legally discharged. So if one of these conditions is met, it's seen as a new issuance of a new debt. If it's not, it's just treated as a modification. If it's a settlement, you're going to remove the old debt. So you're going to debit your notes payable. And you're going to credit using the new debt, using now the new interest rate to discount it if there is a new market rate. The difference between the two is going to be booked as a gain or loss. The bank on their side, they're essentially going to do the same thing, but they're going to, when they're going to find the present value of the new debt, they're going to use the old market rate. If it's only a modification, what the company is going to do is they're not going to book any gains or losses. They're just going to find the new rate and discount their debt using the new rate. So what I mean by that is the present value is the book value of the old terms, so what they have in their books right now. The future value is the new maturity value of the new terms. So what are they going to owe to the bank at the end? Payment is going to be the new maturity value times the new coupon rate. The number of periods is the number of payments until settlement of the new terms. And then your key, you're going to find it using your table or your calculator. And then you're going to do an amortization schedule where you find the interest expense that is used to discount up to your future value. There's probably an example in your book. Maybe it's not example 1418, but there's definitely an example of it in your books if you want to learn more about it. That's for us, the under I for us. You're going to record a gain or loss for the difference between book value of the old terms and the present value of the new terms. And then you do an amortization table as normal. So that's it for the theory for chapter 14. We're going to do the problem. So typical questions on chapter 14 is something on long-term debt or bonds with an amortization schedule, where you either have to fill it out or find the missing pieces, and a question on modification of debt. So for the first question, you have been working as the controller of Zoom Corporation for the past 6 years. Last week, you had appointed a bright young student, Dai Bit, from Concordia University as a work-study intern for 1 year. By the way, in your exam, you're gonna have like a long, like this, like mise en contexte of the problems. Skip through it. Like if you have a paragraph and you don't see any values and it's like long-term debt, you just skip to like the table and then the information, because they're trying to make it fun for you guys to read, but there's nothing more, there's no more value added to your problem. So here basically what they're saying is that the amortization schedule got shredded and they're missing some pieces, and then the intern is like super stressed out because he needs to figure out what was going where to redo the schedule that he just shredded. So they're asking you to figure it out. So he says that he's not able to reproduce this table, and they hope that you can, and I hope you're not going to CAD me tonight. He did not know the maturity value, saying I'm pretty young and I will be called mature after a long time. About the coupon and market rates, he responded, I really do not clip any coupons. My wife does. And since she does all the shopping, I have no idea about all the market prices. We were told that the total cash interest over the life of the bonds would amount to $840,000. Further, 13 interest installments were recorded up to up to and including the one on December 31st, 2020, and that the 12 additional interest installments were due after December 31st, 2020. Interest payments were scheduled every June 30th and December 31st. And so you sit down and show him how to reconstruct the table. In doing so, you need to answer the questions listed below. Determine the interest rate at which the bonds had been issued. So that's the interest expense rate, interest rate. So I'm just going to reproduce quickly that schedule. So first, what you want to find is the interest expense. So the interest expense, sorry, not interest expense, interest rate, market rate. So the interest rate is used to calculate your interest expense. And your interest expense is calculated by doing your interest rate times the previous balance of your bonds payable. So your previous book value of the debt. So in this case, we have here something interesting. We have the interest expense, and we know that to get this interest expense, we had to do the previous book value of the debt times the interest rate. So we have two elements. So we can do a little bit of algebra, I think, to get to our interest rate. So if we do 24,952 is equal to K times 6.3793, all we have to do to get to our interest rate is to do the 6,223,000 divided by 24,952. Nope, reverse. We have to do 24,952 divided by 6,223,000. And that gives us an interest rate of 4%. That 4% is for the period only. And here they're asking us for the yearly rate. So since there's two periods of payments per year, we're going to do times 2, and that gives us an interest rate of 8% per year. So here I use 8% to calculate my interest expense. Determine the par maturity value of the bonds. So the only way really you can figure it out is by calculating your amortization table all the way to the end, because we do not know yet what is my coupon rate, which is normally used with the maturity value. So what I'm going to do, I'm going to figure out how many periods is left until I get to my maturity value. And it said it somewhere here that there is 12 additional interest installments that were due after December 31st. So I'm going to add a bunch of lines. And going to see, is that 12? That's 13. So 12 more periods gets us to a maturity date of December 31st, 2026. My coupon amount will not change, so I can copy this all the way down. My interest expense, it's going to be my 8% divided by 2 to get my interest rate per period, times the previous book value, which is 615,000 in this case. The balance owed is going to be the difference between my coupon amount and my interest expense. Since my coupon amount is greater than my interest expense, so my coupon rate is greater than the market rate, greater than the market rate, it was issued at a premium. So that means that my issue price is lower than my maturity value. So at every period, I want to come and reduce this amount. So here, my 623 is lower than my 650. I want my value that I calculate here lower than my 650. So it's going to be this minus the difference between the two. Then I bring this all the way down, bring this all the way down. I forgot to fix this. So that gives me to a maturity value of $480,000. Then they ask us to determine the coupon rate of the bonds. So to figure it out, how you can do it is you have now your maturity value and you also have your coupon amount. So a little bit how we did the calculation here for the interest rate. We're going to do a similar one for the coupon amount. So the 33,600 is done by doing your coupon rate times your 480,000. So to get to my coupon rate, I'm going to do 33,600 divided by 480,000. So it's a coupon rate of 7% per period. So per year, it's going to be 14%. D, determine the date on which the bonds were issued. So here, what was the first date that we have here? It said in the problem that there was 13 interest installments that were recorded up to and included the one on December 31st, 2020. I'm going to add a bunch of line here. So I should get to 12. I'm at 9. I'm at 12. I'm checking my count here. I'm at 12 interest period here. It wasn't done properly. Oh. 2020. Okay, so if I check this, I'm at 12. It's 13, including the, yeah, okay. So 13 interest installments were recorded up to and including the one December 31st, 2020. So including the one on December 31st, 2020, I should get here to 2014, 12, 31. So that's when there was the interest expense that were calculated. But your interest expense is normally calculated one period after the issue date. So if we had one more issue date, like period here, it was issued on June 30th, 2014. So I can start calculating my amounts on December 31st, 2014. And then lastly, calculate the issue price of the bonds on the date they were issued. So what is the value that I would have put here? To find this, what you can do is just present value, because you have all the information now. You have your future value, you have your payments amount, you have your interest rate, you have the number of periods. So my future value is my maturity value of 480,000. My interest rate, which is per period, is 4%. The number of period is 25. And the payment is the $33,600 amount of coupons. So my present value is $704,000. That's the issue price. Any questions for this? You can also complete like the table if you want to. So if this is equal to this, then this is going to be this divided by 2 times this. So this is just the same formula as I did here. Calculate everything. So there is your completed amortization schedule that was shredded by the intern. So then we're going to move on to modification of the debts. On December 15, 2019, Music Equipment Inc. contacted Trumpets International Bank Inc. in order to discuss ways to renegotiate terms for the long-term debt which it owed to the bank. The debt coming due on January 1st, 2020 was a 6% 5-year note issued at par for $3.2 million, plus the annual interest on the note for 2019. The interest was payable annually on January 1st. The new terms agreed upon by both parties were as follows. The amended terms will become effective January 1st, 2020. Music would transfer a vacant industrial property with a book value of $360,000, accumulated depreciation of $146,000, and a fair market value of $192,000 in full settlement of the annual interest for 2019, which was due and unpaid as at December 31st, 2019. The principal payable was reduced to $2.8 million and will be due January 1st, 2026. The annual interest coupon rate was to be reduced to 5% for the years 2020 to 2025, and the market rate was determined to be 9% on January 1st, 2020. Interest was paid annually on December 31st. So show how this debt with the new terms is to be classified. So we need to see here, is it a modification or a settlement of the debt? To do that, we need to find the present value of the new debt, of the debt, with the new terms, using the old interest rate. So I'm finding my present value. My future value is now the $2.8 million. My old interest rate is 6% because it was issued at par, so my interest rate is equal to my coupon rate. The number of terms there is now is 6. Due January 1st, 2026. So it's 6 years from 2020 to 2026. And now the new coupon rate is 5%. So the new payment amount is going to be 5% of my maturity value. So 140,000. So my present value is $2.6 million. However, they haven't paid their interest yet. So this needs to be added into the consideration of the hold on, sorry, I was just checking my solution. I think I made a mistake. Okay, yeah. Okay, so this needs to be included in my present value of the new terms, because you have two components. You have the component of the interest that hasn't been paid yet. What is that value? And you also have the portion of what is the present value of the new terms. So for the settlement of the unpaid interest, that value is $192,000, which is the annual interest of 2019, which was 6% times 3.2 million. But it's also the fair market value of the asset. So they made it simple, they matched it. And then it's also the present value of the new terms, which is 2.6. So that gives me a present value in total of 2.8 million. Then we need to also find what is the present value of the old terms. So the debt was owed now. It was owed in December 31st, 2019. So it was to its maturity value, which is the 3.2 million. And there's also the unpaid interest, which is 192,000. So that gives a present value of 3.3 million. So we have to find what is the difference between this and this, and if it's greater than 10%, then it's going to be a significant settlement of the debt, or a significant change. So how you want to find your percentage? You do it's new or old minus new divided by new. So in this case, it's going to be the 3.3 minus the 2.8 divided by 2.8. So it's a change of 18%, well, 19%. So it is greater than 10%. So it's significant change. So in the book of the company, they're going to have to remove the old debt from their book and registers a new present value of the debt. That's requirement 2B. So first, we're going to do the transfer of the property, which is you want to remove the accumulated depreciation. You want to remove your interest payable that was set up. And you want to remove the assets, which was a property. Interest payable was 192,000. Accumulated depreciation was 146,000. And the property, its cost was 360,000. So your transaction is not balancing right now. So the difference between the debits and the credits is going to go as a loss because my debit side is lower. So it's going to be this minus this minus this. So it's a loss of 22,000. Did I lose anyone? Because I feel like I'm going quite fast. Okay, I'll take that as a no. And then to record my negotiated debts, what I'm gonna want to book is remove my old notes payable. Now you're just looking at the current debt portion, so the 3.2. This is the old. And I want to put it in the new. But we want to book in the new using the new interest rate, which is now 9%. So here, instead of adding 6%, I'm going to add 9. That gives me a present value of 2.2 million. And then since my old present value is greater than my new, I've made a gain because now I have to pay less money to the bank. So it's going to be a gain on settlement of debts. And it's the difference between the two. For C, under the renegotiated terms, would Trumpets International Bank make a gain or suffer a loss on the negotiated debt? Provide the journal entries. So on the bank side, what's going to happen is that they're going to have first, they're going to receive a property at a fair market value of 192,000, and they're going to reduce their interest receivable by the same amount because that was the amount of interest that was owed. So they're not looking at any gain or loss for that. And then you want to calculate what is the value of the new terms for them and remove the old terms from their book. So for them, they had a note. They were supposed to receive a note of 3.2 million. Now they're going to receive a note receivable of 2.6 million. I'm using the old interest rate because for them, for the bank, the change in interest rate and market rate doesn't affect them. So you're going to use the same present value as you found here. And then the difference between the two is going to be a loss, or can be a loss. They can also book it as bad debt expense. They can also book it as AFBA. So I don't remember what the first A is, but for that full account, so whatever amount of receivables you think you're not going to be receiving. And that is going to be 537,000. And that's it for chapter 14. A lot quicker than chapter 13. Any questions? Okay. For chapter 16, I'm going to be skipping a few slides because, yeah, Elizabeth? Oh, I cannot hear you if you're talking. You can write it in the chat if yeah, for zero coupon bonds, it's no, you shouldn't know them. I don't think they're going to be asked. They're not asked normally. I do have the theory in the chapter 14 PowerPoint if you want to go look over it. But they don't really ask about it. No problem. So chapter 16, sorry, goes hand in hand with chapter 14 because we're talking a lot about warrants and convertible bonds. And these two are calculated using what we just learned in chapter 14. So a financial instrument, now, if you don't understand that, it's okay. It's just going to help you when you're doing your CPA classes, if you do your CPA classes. So a financial instrument, it's something that creates a financial asset in a company and a financial liability or equity in another company. So one company is going to record an asset and the other is going to record a liability or a equity instrument. For us, what we're interested in is the financial liability or equity instrument parts of the financial instruments. You should have seen the financial assets in ACCO310, but maybe not like put down like that. You have two types of financial instruments. You have the primary financial instruments. So those are basic, like cash, like shares, accounts payable. And you also have derivative instruments. And those instruments, they get their value from something else, from another financial instrument or non-financial item. So for example, a warrant is going to get its value from the shares that the companies are, the warrants holder are going to be able to buy. The warrant in itself doesn't really have any value. It gets its value from the shares under it. So those are derivatives. So the value of, let's say, a warrant is going to change depending on the value of what's attached to it. And someone doesn't really need to spend any money to buy a warrant, just the warrant. There might be buying a bond with the warrant attached to it, but they're paying cash for the bond and there's a warrant. That makes any sense. And for derivatives, they're settled at a future date. So they're not getting it now. They're not getting the benefits now. Derivatives are measured at fair value. That's okay. If you don't, it's okay if you don't understand that. It's not going to be asked. You have options and warrants, which they gives the holder the contractual right to acquire or sell an underlying instrument at a specific price. So I get a warrant. I decide to get a warrant, and I have the right to get a share at a specific price within 2 years. So because the price of the share is fixed in the warrant contract, if on the market, the price of the shares fluctuates a lot, it gets a lot higher or it gets a lot lower, I'm protected from the risk of those fluctuations because I have a set price and I'm not obligated to exercise my warrants. I can let it get like, I can just like not exercise my rights and just not get the shares, and it's okay. I can also decide to exercise my rights with warrants, buy the shares at the strike price, and now I have shares. Normally, what warrants holder will do is that they're going to buy the shares at the strike price when the market price of the share is a lot higher, because now they're getting shares at a cheaper price than what they would have paid on the market. If you've done come through 8, you've probably seen call and put options. These are also derivatives where you have the option to you buy an option to either sell or buy shares at a specific strike price, and you're not obligated to actually exercise that right. Options come more in later chapters when we're going to be looking at earnings per share. There's not really a lot of problems on it. What you need to know for options is that they're or just derivatives in general, they're valued at their fair market value. So when they are issued, you're going to issue them at their fair market value. If the value fluctuates between the issue date and the end of the year, you're going to book a gain or loss to bring your financial asset to the value of the fair market value of your option. And same thing on the rider side for the liability, you're always going to record it at its fair market value. So you can book gains or loss depending on the fluctuation of the fair market value. You don't have to find out what the fair market value is. Normally it's given to you with specific dates, and then you just do the journal entries for that. And then at exercise date, I'm going to look more at the rider because that's where the liability is. What happens is that the older of the option is going to be, okay, I'm either going to buy or sell my shares at the price that was on my option, at the strike price. On the market, there's definitely a different price than what there is. So the company is going to either sell its share to the exercise price or buy the shares on the exercise price. And the difference between that and the market price of the share is going to be booked as a gain or loss. Okay, important here, convertible bonds. So convertible bonds are bonds that can be converted. Normally, they are converted into shares of the company. But it could also be converted into other things. Convertible bonds can also have warrants that are attached to it, but the warrants are valued separately from the convertible bonds and the bonds. And the warrants are considered equity. The convertible bond portion of the bond is also considered equity. So the warrants and your convertible bonds are going to be included into the contributed surplus part of the equity. So in your balance sheet, you have assets, liability, equity, so it's going to be in there. So when going to be issuing the bonds that have a convertible rights attached to it, you're going to have your cash amount, that is the amount of cash that you've received. You're also going to have a contributed surplus conversion right. That's the equity part, and that's the valuation of the convertible rights of the bonds. And you also have your bonds payable, which that is only what is the issue price of the bonds, like we saw in chapter 14. So that's without looking at what's the contributed surplus. If the bonds were just issued on the market, normal, without any conversion rights, how much would they be issued for? When the bonds are converted into common shares, you're going to remove the bonds from your books at their book value. You're going to remove your contributed surplus conversion rights for the amount that was booked at issuance. And then the common shares that were issued are just a plug amount. So you're not looking at the market value of the shares. You're really just plugging the number. If there's only a percent that is converted, then you're going to do a percentage of the bonds payable book value at issuance, and just a percentage of the book value of the bonds, and also a percentage of the contributed surplus that was booked at issuance. If at the end of the contract, no one decided to exercise their conversion rights, you're going to remove the bonds payable from your book. You're going to remove the contributed surplus from your book, and you're going to cash in the difference. So you're not going to be issuing any shares. Under ASPE, when the bonds are when they are converted earlier than what was under the terms, the cash payment so basically the bondholders are going to be paying a little bit more to be able to convert them earlier. That cash payment is going to be assigned first to the book value of the bonds. So to remove completely the bonds from your books. Then the leftover is going to be assigned to debt retirement. It's first going to be to, it's first going to be to debt retirement costs, if you have any. And then if you still have a leftover, it's going to be to return earnings. So it's going to come and reduce your equity. If the bonds are converted earlier in IFRS, instead of booking it to debt retirement costs, you're just going to, or return earnings, you're just going to book it directly as a loss on retirement. And that loss is going to be in your P&L. And at the end, it's going to reduce equity also when it goes through the motion of the financial statements. That's it for chapter 16. We're going to do a question on convertible bonds. I find it like a little bit hard conceptually, like this chapter, I guess it's me, but the problems are pretty straightforward and they always come back to around the same thing. So you meekly step out to grab a coffee with the hope that the boss does not stop you on the way. You learned that from his notes in the new file that Fix All had issued 28,500 convertible bonds at 121 on January 1st, 2019. The $1,000 par value bonds carried an interest rate of 8% and a 15-year term. Interest was to be paid by the company on June 30th and December 31st. Each bond came attached were 16 detachable warrants. A warrant holder was entitled to purchase with each warrant one share from Fix All at the price of $57. Further, each bond was convertible at the option of the holder into 16 common shares. The underwriter informed the company that the bonds alone excluded warrants and conversion rights could be issued in the market at a 6.5% premium. Similar warrants were being traded at a market value of 4% each at the date of the issue. You have been asked to view this situation on the assumption that the company uses ASPE for its accounts, records debt first, and amortizes the bond using straight line. So first requirement is to do the journal entry to record the issue of the financial instruments on January 1st, 2019. So at issuance, you're going to receive cash. You're going to have a portion for your bonds payable. You're going to have a portion for your contributed surplus warrants because they come attached with warrants and the warrants are valued separately. And you're also going to have a contributed surplus for your conversion rights. First, we want to find out, I think it's easier, the cash is not given to us, right? Oh yeah, it is. It is. Yeah, so the cash amount is given to us. So we know that all the bonds, the 28,500 convertible bonds, were issued at 121 on January 1st. So that means that they were issued at 21% more than their par value. So what you're going to do is you're going to find the monetary value of your bonds. So it's going to be the 28,500. So that's the number of bonds times their 1,000 par value. So each bond is worth $1,000 times 1.21 because they were issued at 121. Then we can come here and find out what's the bonds payable. So amount. So what is the issue price of my bonds if I went on the market and bought them without them having any conversion right or warrants attached to them? So they said that the underwriter informed the company that the bonds alone, excluding warrants and conversion rights, could be issued in the market at a 6.5% premium. So the 6.5% premium is on the par value. So it's going to be the par value plus 6.5%. So my par value is the 28,500 bonds. So that's the number of bonds that was issued times $1,000, which is the par value of the bonds, times 1.065 because it was issued at a premium. So they were issued at a higher price. If it was at a discount, I would have done times 1 minus 6.5%. So that gives me bonds payable amount issue price of 30 million. Then for my warrants, we need to find the number of bonds that were, the number of warrants that are attached to each bonds, and also their strike price. And also their market price. So there's 28,500 bonds. Each bonds have each bonds came attached with 16 detachable warrants. So I'm going to do times 15 warrants. And at the date of the issue, the market value of the warrants was $4 each. So I'm going to do $4. So that gives me a value of 1.8 million. And then for my conversion rights, it's just going to be to make your transaction balance. You're not going to have, it's always a plug. Even if there wasn't any warrants, then you would have plugged the amount to get to your contributed surplus. Then, prepare an appropriate journal entry to record the interest expense on December 31st, 2021. So something that's important that was noted is that the company uses ACCO for its account, record debts first, and amortize the bonds using straight line amortization. So under straight line amortization, I amortize the difference between my issue price and my maturity value. So my issue price is my 30 million, here. And my maturity value is the 28,500 bonds times $1,000. So the difference between the two is 1.8 million. Then I want to see, okay, how many periods do I have for the bond? So over how many periods do I amortize this amount? So it's a 15-year term. And interest was to be paid by the company on June 30th and December 31st. So my number accrued is 15 years times 2, because there's 2 interests, well, period per year. So my amortization amount per period is this divided by this. So $61,750. So I'm gonna have my bonds payable that were issued at a premium, right? Because my issue price is greater than my maturity value. So I'm gonna come and debit them by $61,750. I'm gonna have my cash amount, which is my coupon amount, which that is my maturity value times my coupon rate, which is 8%. No, it's not 8%. Oh, it's 8% divided by 2. And then I'm gonna have my interest expense, which is the difference between the two. Then they're asking on July 1st, 2022, 65% of the warrants outstanding were exercised by the warrant holders. The company's shares were being traded in the market at a price of $62 each on that day. Prepare an appropriate journal entry to record this transaction. On July 1st, 2022. So I want it to issue common shares because 65% of the warrants were issued. So I'm going to receive money from the warrants. I'm going to reduce my contributed surplus from the warrants, and I'm going to be issuing shares. So the amount of money I'm going to be receiving is 65%. Yeah, okay. So 65% times the number of bonds that were issued at first, so 28,500, times 16 warrants per bond. So this is my 65% number of warrants that were issued. And then the price of the shares that the warrants holders were signed off on, like the exercise price, was $57 for one share. So a warrant holder was entitled to purchase with each warrant 1 share at a price of $57. So technically, if it was 2 shares, we would do times 2 here to take into consideration the 2 shares that they're able to buy. But I'm just going to do times 1 times $57 per share. So that's the cash amount that the company has received. Then they come and reduce the contributed surplus per warrant that was set up at the beginning. Since only 65% of the warrant holder to exercise, it's only going to be reduced by 65%. And then the common shares that are issued are just going to be the sum of the 2. You're not looking at the market price because they weren't issued at the market price. They were issued at the warrants strike price plus a little bit of the contributed surplus. And then on July 1st, 2023, 60% of the bondholders submitted their bonds for conversion. The company's shares were being traded at $72 on that day. The company had duly recorded and paid off all interest accrued and due on the bonds up to June 30th, 2023. Prepare the appropriate journal entry using the book value method to record the conversion of the bonds on July 1st, 2023. So first I want to find what is the book value of the bonds on July 1st, 2023. My book value at issuance was the 30 million here. Then there was some amortization of the bonds payable. So that came and reduced it. We're on July 1st, 2023. This was on January 1st, 2019. So how many periods has it been? If I check here, if I do on June 1st, 2019, December 31st, 2019, this is 2020, this is 2021, this is 2022, this is 2023. Oops, June 30th. So there was 9 payments of interest up until July 1st, 2023. It is said that they have paid their interest up until June 30th, 2023. So we have no leftover. So I'm going to do my $61,750 that I calculated here times 9 period. And to find my book value on July 1st, I'm going to do my book value at issuance minus my amortization. So that gives me a book value of 29 million. Then it says that there was 60% of the bondholders that they submitted their bonds for conversion. So that means that 60% of this amount was converted. So 17.8 million was converted. So that's, we're going to reduce our bonds payable by that amount. We're also going to reduce our contributed surplus for conversion rights by 60%. And then we're going to issue common shares for the sum of the two. Again, we're not looking at market price here to find out our common share amount. Then we have E, how many shares would have been issued from the bond conversion on July 1st, 2023. So 516. So each convertible bonds could have been converted into 16 common shares. So what you're going to do is you're going to find how many bonds were converted. So that's 28,500 times 60%, and times the number of shares that were converted into, which is 16. So that gives us 273,000 shares that were issued. And that's it for chapter 16. Do you have any questions on anything? I'll stop the recording too.